The name of the corporation is called Roots Corporation. Underneath, we have the head office address, and then we have the website address. The fiscal year was from February 2nd, 2019 to February 1st, 2020. One of our visions is to inspire the world to experience everyday adventures with comfort and style. My name is Eliza Khan, and this is our annual report for Roots Corporation. Our products contain comfortable cabin meet style that includes women's and men's apparel, leather goods, footwear, accessories, as well as kids, toddler, and baby apparel. Our date of formation was in 1973, so it's been 48 years. Our locations include Canada, and specifically inside Canada, we have Ontario, Quebec, Manitoba, British Columbia, Alberta, Nova Scotia, Newfoundland, New Brunswick, Saskatchewan, and then the US. There are 120 locations across Canada, 4 locations in the United States, and 138 stores in Taiwan and China. Our industry classification is consumer products. We currently have 2,200 people employed, and Roots have a strong commitment to health, wellness, and protecting the environment. We have developed custom products for hundreds of films, TV shows, concert tours, and other cultural events, as well as organizations. Some major competitors that we have are Aritzia, Canada Goose, Holt Review, Barney's New York, Reformation, Zara, Lauren James, and Toby. Nestle is ranked number 1 for consumer goods companies. Nike is the biggest market leader in clothing specifically. When looking at our health, the consumer product industry is dependent upon the ability to access consumer data. E-commerce, which is buying items online, will continuously to increase, causing businesses to keep going. Due to the COVID outbreak in 2020, the apparel side of consumer products are under a slow recovery, and overall sales are expecting to trend under pre-crisis levels until 2022 and 2023. Companies are recommended to protect market share in order to improve profitability. Apparel purchases are less than 2.5% of total spending by consumers in 2020, and compared to 5.3% in 2019. When focusing specifically on apparel, it's expected to remain low even when the consumers return back to normal. Our target market consists of men and women ages from 18 to 35, teenagers, young adults, and the consumer product industry sells items to individuals that include food production, packaged goods, clothing, beverages, automobiles, and electronics. So that's like in general. When looking at the product life cycle, our company is currently at the maturity stage. This is where the manufacturer has to maintain their market share that they have already built up. Since Roots had their growth stage in the 1980s and continued to grow since then, it has reached its max popularity, and therefore we must maintain it. This is also the stage where they make improvements on their products in order to gain a competitive advantage, where we might come out with new products such as footwear to maintain the brand's market share. So over here at the graph, you can see the growth stage is between the introductory stage and the maturity stage. So that was us in like the 1980s. And now since we're at the maturity stage, we are right before the decline stage. So in order to not decline, we have to maintain our overall business. So one key success is that we enhanced e-commerce, which ended up being the fastest growing part of the business. We opened 6 new stores during the year in Canada and worked on to capitalizing the high-performing stores, such as renovating 4 and relocating and expanding 6. We expanded into 2 new markets in the United States, in Boston and Washington, D.C., by opening 2 stores in each city. One key plan that we have for the future is that our world-famous sweats will be evolved continuously and are planning to introduce new styling and materials. The overall range in the brand will include more transitional seasonal products, and each product launch is hoping to be targeted in each quarter. From the management's discussion and analysis, it's in accordance with the IFRS that is issued by the International Accounting Standards Board. On February 3rd, 2019, the company adopted IFRS 16 using the retrospective approach, which means that they look back at events that took place or works produced in the past. References to non-IFRS, including certain metrics, these measures are provided as additional information that provides understanding from management's perspective. It refers to the comparable sales growth decline as a metric that is commonly used that is different from other companies. Non-IFRS measures used and metrics that provide valuable information to management and investors for measuring financial performance, as well as they highlight trends that may have not been shown if we solely relied on IFRS. Management also uses non-IFRS to exclude certain expenses and income that they believe do not affect the company's operating performance. Adjusted DTC gross profit is known as gross profit, direct to consumer DTC, adjusted for the impact of certain costs of goods sold. EBITDA is net income loss before the interest expense. And comparable sales growth decline is the retail industry metric to compare the percentage of change between sales from stores and e-commerce. So when looking at the report, the Independent Registered Public Accounting, the names of the accounting firm that prepared this audit are known as KPMG LLP. The auditor states that financial statements are presented fairly. The consolidated financial position of the independent statements at February 1st, 2020 and February 2nd, 2019, as well as cash flows and financial performance, are in line with the International Financial Reporting Standards. In Note 1, the entity's liquidity cannot be estimated because the company has temporarily reduced supply chains and distribution channels because of COVID-19. Material uncertainty is known and can show significant doubts on the entity's ability to continue as a growing concern. In Note 2 of the financial statements, it has changed its policies for leases since February 3rd, 2019, due to the adoption of IFRS 16 leases. So for the notes to financial statements, they can provide information that isn't always found on the actual statements, such as the balance sheet, income statement, cash flow statement, as well as the statement of changes in equity. They also explain how exactly the company got their numbers in their financial statements, as well as help explain any irregularities that someone might not understand completely. These can come up as text, graphs, or tables. They also explain assumptions that might have been used in order to explain financial statements. When looking at specifics, the notes can explain where the company's revenue comes from, accounting policies, as well as changes, estimates, and judgments, subsequent events such as acquisitions, depreciation of assets, and inventory valuation. One specific note in this section is known as goodwill. Goodwill is an intangible asset that can focus around having an advantage of a good reputation in the business world. It is known as a capital asset and provides an ongoing revenue generation benefit for a period that extends beyond 1 year. The value of projected earnings increases for a business part of their purchase price. When looking at the notes to the financial statements for Roots, specifically focusing on goodwill, it mentions that they assess goodwill by comparing the carrying value of each CGU group, which is known as cash generating group, to the recoverable amount of the CGU group. Goodwill was distributed to the grouping of CGU that represents the lowest level in the company at which the assets are monitored. Some assumptions for the company's annual impairment, as at February 1st, 2020, include annual sales growth up 4%, terminal growth rate of 2%. Roots impaired a loss of $44,799 in thousands of Canadian dollars for the period ended February 1st, 2020. So when looking at share capital, Roots authorized share capital consists of unlimited number of common shares as well as unlimited number of preferred shares that are issuable in series. Common shareholders are allowed to have 1 vote per share at a shareholders meeting. Preferred shareholders are given preference over shares with respect to dividends but aren't given voting rights at meetings. No dividends were declared during the periods ended February 1st, 2020 and February 2nd, 2019. During the period ended February 1st, 2020, 4,220 shares were issued from Treasury as a result of the 4,220 restricted share units granted under the Omnibus Plan. During the period ended February 2nd, 2019, 139,731 shares were issued from Treasury due to the 139,731 stock options granted under the Legacy Equity Incentive Plan. As at February 1st, 2020, there were 42,124,451 shares and nil preferred shares, which means 0, that were issued and outstanding. All issued shares are fully paid. So when looking at stock price, Roots stock is traded on the Toronto Stock Exchange. The stock exchange symbol for Toronto's is known as TMX, TSX, or TSXV. Root's stock ticker symbol is shown as ROOT. The common stocks are currently trading at 2.22 CAD. Some historical trading prices in the last 52 weeks considered of a low of 0.63 CAD on April 3rd, 2020, which makes sense due to the COVID-19 outbreak, and a high of 2.56 CAD on December 15th, 2020. When looking at the past 5 years, Roots had a high trading price of 13.53 CAD on May 4th, 2018, and a low of 0.63 CAD, as mentioned previously on April 3rd, 2020. From last year, the stock is up by 13.27%. So here we have the horizontal and vertical analysis. When looking at the horizontal analysis, we can see that revenue had increased by $837,000, which can also be described as 0.25% from 2018 to 2019. Net income had decreased significantly in 2019 compared to 2018, since it went down by 534.14%, which is also $75,607,000, resulting in a net loss in 2019. In relation to going down, total shareholders' equity decreased by 29.9% from 2018 to 2019, resulting in a lower equity of $64,198,000 in 2019. This is due to the expenses exceeding assets and revenue while also having a high cost of goods sold. When looking at the vertical analysis, the base amount for the balance sheet is the total assets, and for the income statement, it is net sales. The comparison between total current assets and total assets is 12.2%, and between total non-current liabilities and total assets is 50.6%. The vertical analysis for the income statement states that the comparison between profit before income tax and net sales is 17.3%. And here is basically everything I just said that's condensed. When looking at ratios, liquidity ratios are used to find the debtor's ability to pay off debt obligations without external capital, especially in an emergency business situation. When looking at current ratio, this measures short-term debt paying ability, and therefore the company would want it to be higher, so creditors know that the debtor is able to pay them back. In 2020, the current ratio was 0.80 to 1, and in 2019, the ratio was 1.26 to 1. As you can see, Roots had a stronger debt paying ability in 2018 compared to 2019 due to them having a higher current liabilities in 2019 and lower current assets compared to 2018. They could have definitely improved in their 2019 year and continue to improve for the future, since having a lower current ratio could cause creditors to not give loans to Roots, which can impact their net income in the future. That's on the income statement, as well as lower shareholders, bringing down their overall business. The asset test ratio measures immediate short-term debt paying abilities, and therefore a company would want that to be high. In 2019, the ratio was 0.20 to 1, and in 2018, the ratio was 0.30 to 1. Once again, 2018 had a higher ratio compared to 2019 due to them having more current assets such as inventory and lower liabilities than their values in 2019. The asset test ratio is seen as a more conservative estimation of the company's financial health. Therefore, the higher it is, the more financially healthy it is. When creditors see a company with a high asset test ratio, they are most likely to trust the company to pay back their loans in an emergency situation such as their business shutting down or going bankrupt. Therefore, the creditors have more trust in the debtor's company and will most likely give them a loan. Return on assets measure the overall profitability of assets and gives investors an idea of how effective the company is for converting money that it invests into net income. In 2018, Roots had a higher return on assets due to having a high profit compared to 2019, having a gain instead of a loss, which means that they were earning more money on less investment. When looking at the return on equity, it measures the profitability of shareholders' investments. In 2018, it was 6.84%, and in 2019, it was negative 33.65%, meaning that in 2019, there was less efficient usage of equity capital and a net loss. The debt to total assets measures the percentage of total assets provided by creditors, and therefore the higher the percentage is, the more risk the company has for falling, since the majority of the assets are funded by creditors. In 2019, the percentage was 65.85%, and in 2018, it was 43.66%, meaning that in 2019, Roots had a higher financial risk and degree of leverage compared to 2018. The higher it is, such as in 2019, investors wouldn't want to invest in so much into the company, knowing the company doesn't own majority of their assets. Finally, interest coverage measures a company's ability to pay interest payments, and ideally you would want the value to be high, showing the company has enough profits available for debt, but can also mean that the company isn't borrowing enough. For example, if it's too high, the company may not be investing in new products and tech to stay ahead in competition in the long run. In 2019, it was negative 2.28, and in 2018, it was 4.73, meaning there were higher profits in 2018 compared to 2019 to pay interest payments. Overall, when comparing the 2 years, it can be seen that 2019 needs more improvement with all the ratios compared to 2018 because of the loss that Roots experienced then. Their major strengths were shown in 2018 due to their gains and were all positive. So this sums up what I just said. If I were the CEO of Roots, my vision for the company going into the future to ensure growth and success would consist of continuing to grow store locations internationally, such as in colder regions in the US as well as in Europe and Asia, to gain more profits from different parts of the world. Having more locations internationally can help build net income so the company wouldn't have to suffer a loss anymore, like the one in 2019. Due to this, stock prices can go higher. I would continue to develop custom products for films, TV shows, concert tours, and other cultural events, as well as organizations, to continue to gain awareness on our products and making a profit from doing so. E-commerce is something that will continue for the future of Roots to ensure continuous growth that will cause the business to keep growing by giving people access to our products from all different parts of the world, adding on to revenue. We would continue to protect market share in order to improve profitability. Since Roots is at its maturity stage, in order to continue to grow the brand, I would compete with my competitors by making improvements on our products every 6 months to gain a competitive advantage, such as using more promotions, testing new materials, and bringing in new products to the line. Once COVID-19 starts to lift, we will then bring back supply chains that were previously reduced, as well as the distribution channels to get the brand going again. In hopes of the business continuing to grow, there will be more demands for stock, so we can count on stock prices increasing as well. As for ratios, in order to keep them at our desired results, we must control our current liabilities and make sure our current liabilities don't exceed our current assets, so we can get a higher liquidity ratio for our current ratio, and so we can be confident with not being swamped by debts. This will also let us get more loans when needed more easily. By having a strong asset test ratio, we can ensure that we can cover any immediate liabilities that may occur, knowing our business will survive. We must manage our expenses by reducing them so we can have a high profit in general, and by having more revenues than expenses. That can lead to a higher return on assets ratio, which is good since we can then earn more money, net income, on less investment. In addition, having high total assets and low total liabilities can aid for a company's future regarding the debt to total assets, by making sure a company isn't at risk without financial leverage as well. It can ensure that it will continue to survive and grow. In my opinion, we should hand out dividends to the shareholders during years in which the business is doing extremely well, which will then attract more investors and create higher demands for stocks at a higher price. I feel that the price of the common stock is going to go down in the future because of how the company looks in the market summary chart for the last 5 years. As you can see, the highest peak in the last 5 years was during May 2018, and it has been going down throughout the years. Especially with COVID-19, the industry's economic profit is going low and overall slowing businesses down, since consumers aren't buying as much anymore and distribution channels as well as supply chains are being reduced. I personally believe investing in a consumer product stock, specifically clothing, isn't a good investment right now since prices don't look like they're going up anytime soon. Even though it's well known to buy stocks low and sell them high, with this specific industry and circumstances, I don't think it's a good investment as it's going to take a lot of time for it to get back up. So in the meantime, you should invest in something that will go up greatly in a shorter amount of time. You should also invest in something that you can guarantee will go up and won't be affected as much by things like COVID-19. Like I mentioned before, I wouldn't recommend my parents to buy the stock for their retirement portfolio because it is not a reliable stock that will give you the amount of money that you're looking for, especially for retirement. Since this stock is something that can get easily affected by a pandemic and is clothing, I would suggest my parents to invest in a stock related to technology, since technology is always going to get updated in the future and is guaranteed to change, therefore guaranteeing the prices will go up more. An example of this would be Tesla. Meanwhile, for clothing, there's only so much that they can upgrade to make stocks go up to have a competitive advantage. I hope you enjoyed. Thank you for listening.